Imagine a portfolio so robust, so resilient, it could stand firm against the fiercest economic storms. A strategy not just for growth, but for true survival. Is such a thing even possible? Welcome to the Financial Compass. Today, we're dissecting the three-position portfolio, a strategic allocation designed for all economic seasons. It's not about predicting the future, but preparing for every possible outcome. But how does it really perform when disaster strikes? For this analysis, we define the three-position portfolio as strategically diversified across three core pillars: equities for growth, long-term government bonds for deflationary protection, and gold cash for inflation and crisis hedging. Each serves a unique purpose, aiming to thrive when others struggle. Our journey begins with the cataclysmic Wall Street crash of 1929 and the subsequent Great Depression, a time of unprecedented deflation and economic collapse. Equities plunged, taking decades to recover in nominal terms. During this period, the three-position portfolio found its strength in an unlikely hero: long-term government bonds. They were the ultimate safe haven, performing well as the economy deflated and a flight to quality ensued. Next, we face the 1970s, a decade synonymous with stagflation, stagnant growth paired with soaring inflation. Here, traditional stock and bond portfolios suffered immensely. But the three-position portfolio had its secret weapon: gold. It was the best performing asset, surging dramatically as a hedge against currency devaluation and rising prices. Real assets, like commodities, also thrived, protecting purchasing power. Fast forward to 2008, the global financial crisis. Systemic risk was rampant, and correlations between assets spiked, challenging modern portfolio theory. Equities saw massive declines. Again, diversification proved its worth. High-quality fixed income, especially U.S. Treasury bonds, acted as a vital stabilizer, limiting losses and even seeing returns as investors sought safety. The bonds offset some of the equity pain. The COVID-19 pandemic in 2020 triggered another sharp, albeit brief, market downturn. Initial panic saw widespread drops, but swift government and central bank responses cushioned the blow. During this period, investors globally reallocated, shifting towards conservative assets. Insurance and gold saw increased preference, highlighting the demand for stability and hedges in uncertain times. Our most recent test, the 2022 bear market. This crisis presented a unique challenge as both stocks and bonds, traditionally uncorrelated, fell in tandem. The classic 60-40 portfolio struggled significantly. However, once again, the inflation hedging component of our three-position portfolio, gold, held its value significantly better, providing a crucial buffer when both equities and traditional fixed income faltered. Commodities also showed resilience. The core framework of the three-position portfolio isn't complex market timing, but strategic diversification across economic regimes. It explicitly prepares for prosperity, inflation, deflation, and recession, allowing different assets to shine in different environments. This contrasts with some aspects of modern portfolio theory, which, while foundational, sometimes struggles when asset correlations converge during extreme crises, reducing the expected benefits of diversification. In today's dynamic world, characterized by persistent inflation, geopolitical tensions, and shifting interest rate policies, the lessons from history are more relevant than ever. The old regime of consistently negative stock-bond correlation may have fundamentally shifted. Looking ahead, a robust three-position portfolio offers a hedge against various future scenarios: continued inflation, potential recessions, or even unexpected geopolitical shocks. It's about building resilience, not just chasing returns. The winners in such a portfolio are those assets specifically designed for the prevailing economic regime. The losers are often assets tied too heavily to one economic forecast. The goal is for the combined portfolio to consistently smooth returns. So, What are the actionable lessons? First, understand the role of each asset. Second, regularly rebalance your portfolio to maintain your desired allocation and capture the rebalancing bonus. Third, prioritize broad, low-cost index funds for each position. By embracing the philosophy of a thoughtfully constructed 3-position portfolio, you're not just investing, you're fortifying your financial future against the unknown. Don't forget to like, subscribe, and hit the notification bell for more insights on mastering your financial journey.